A stock falls hard for days. Then one morning it opens green, jumps 6%, and social media says the bottom is in. This is where beginners get trapped. They confuse relief with repair. They see one green candle and imagine the old high coming back. But a bounce only proves that buyers showed up for a moment. A reversal proves that control actually changed. Those are not the same thing. In this lesson, you will learn 5 signs that separate a temporary bounce from a real reversal. No magic indicators, no prediction theater, just a clean process for deciding whether price is repairing or setting another trap. First, understand why beaten down stocks bounce at all. Some traders who are short buy shares to lock in profits. Bargain hunters see a large percentage drop and rush in. Algorithms react to oversold conditions. A favorable headline appears, or sellers simply become exhausted for one session. Every one of those forces can lift price. None of them automatically fixes the reason the stock fell. Picture 2 stocks falling from $100 to $70. Both bounce to $78. Stock A fails under the old breakdown level, rolls over, and makes a new low. Stock B reclaims the broken level, pulls back, holds it, and then pushes higher with broader participation. Same first bounce, completely different evidence. That is why the first green candle is not your answer. It is the start of the test. Sign number 1. Price reclaims broken structure. When a stock breaks an important support zone, that old floor often becomes a ceiling. Trapped holders use the bounce to get out. New buyers face supply from everyone who wishes they had sold earlier. A real reversal has to absorb that supply and close back above the level that previously failed. Do not obsess over one exact penny. Think in zones. A prior support area, a failed breakout, a major moving average, or the last lower high can all define structure. If price rallies directly into that zone and gets rejected, you do not have repair, you have a bounce hitting resistance. The survival question is simple. Did price merely rise, or did it reclaim something that matters? Sign number 2, the retest holds. This is the part beginners skip because waiting feels painful. After price reclaims a level, it often pulls back. That pullback is not automatically bad. It is where the market proves whether the reclaimed level can become support. Imagine price breaks above 80, reaches 84, and then returns toward 80. If buyers defend the zone and price forms a higher low, the evidence improves. If it slices back below 80 and cannot recover, the breakout may have been a trap. The first rally creates hope. The retest reveals truth. Waiting for a retest means you may not buy the exact bottom. Good, the exact bottom is visible only in hindsight. Your job is not to win a screenshot contest. Your job is to reduce the chance of buying temporary excitement. Sign number 3. Volume and participation improve. A reversal should attract demand, not just a lack of sellers. Watch whether stronger up days come with meaningful volume. Look for price to close near the upper part of its daily range, instead of giving back the move before the close. Then watch whether the next advance attracts buyers again. One explosive volume spike can still be short covering or news reaction. What matters is the pattern. Are buyers repeatedly willing to pay higher prices? Are pullbacks happening on lighter activity? Is accumulation replacing panic? Volume is not a magic truth machine, but price rising on weak participation deserves less trust than price rising while demand broadens. Sign number 4. Leadership and breadth improve. A weak stock can bounce while its industry remains broken. A market index can rise while only a few giant stocks do the work. That is why context matters. If a semiconductor stock is supposedly reversing, check the semiconductor group. If a bank is rebounding, check other banks and the credit backdrop. If the broad market is recovering, ask whether equal weight indexes, small caps, cyclical sectors, and market breadth are participating. Real reversals tend to recruit allies. More stocks hold above key levels. Fewer names make new lows. Leadership stops shrinking and starts expanding. You do not need every stock to turn green. You need evidence that the move is larger than one ticker, one headline, or one crowded trade. Sign number 5. Follow-through survives time. A bounce can happen in minutes. A reversal has to survive multiple sessions. Price should stop making lower lows, begin making higher lows, and eventually challenge or break the sequence of lower highs. The order matters. First, selling pressure slows, then structure stabilizes, then price reclaims a meaningful level, then the retest holds, then follow-through carries price beyond the first bounce high. Beginners want one signal because one signal feels decisive. Markets rarely offer that comfort. Now let us classify 3 common situations. Case 1. The dead cat bounce. Price collapses from 100 to 70, rallies to 76 on one dramatic green day, but volume fades. The stock remains below broken support, the industry stays weak, and the next pullback makes a new low. That was not a reversal. It was temporary relief. Case 2. The tradable bounce. Price rises from 70 to 80, but remains under major resistance. Momentum traders may have a short-term opportunity with strict risk control. Long-term investors still lack proof that the larger downtrend has ended. A move can be tradable without being a durable reversal. Case 3. The real reversal candidate. Price stops making new lows, reclaims the breakdown zone, holds the retest, forms a higher low, and breaks above the first bounce high. Volume improves, the industry participates, bad news stops producing new lows. That does not guarantee success. Nothing does, but now the evidence has changed. Here's the beginner decision tree. First question, did price reclaim broken structure? If no, classify it as a bounce and stop there. If yes, ask, did the retest hold? If no, the reclaim failed. If yes, ask, did participation improve? Check volume, closes, breadth, and industry behavior. Finally, ask, did the move follow through across multiple sessions and break the lower high pattern? The more answers you can verify, the stronger the reversal case. The fewer answers you have, the more you are relying on hope. And remember what this checklist cannot do. It cannot eliminate losses. It cannot identify every exact bottom. It cannot turn a broken company into a healthy one. Fundamentals, valuation, debt, cash flow, and the reason for the decline still matter. Technical repair tells you that market behavior is improving. It does not tell you that any price is intelligent to pay. So here's the survival rule. Do not buy the first green candle just because the chart finally gives you emotional relief. Wait for price to reclaim structure. Watch the retest. Demand participation. Check the group. Require follow-through. You will miss some bottoms. That is the cost of demanding evidence. But missing the first few percent is often cheaper than financing somebody else's exit. A bounce is an event. A reversal is a process. The first green candle creates hope. The retest reveals truth. Before the market charges you tuition, learn how not to get fooled.